let's just get started with what has changed in the post-seed world in the last 6 months. What's the biggest change you see in companies that have raised a little bit of capital and now need to raise more, and what they would have been doing 6 months ago and what they're doing now? And, Chad, you want to give it a shot since you're closest to me geographically?
I think the biggest change. I think the biggest change we see is simply that I think there's been a collective decision by investors to start backing things that are real businesses from the get-go. So we're seeing a lot less companies who have no real business model up front get funded. So these kind of audience-based companies, we've seen a revert back to companies who have a real business model or revenue model from point one. I think following that as well, companies who have proven product market fit, and the way SUSE Ventures defines that is, real happy paying customers. So we do a lot of enterprise software, and there's real no way to mask if a product's not working. If you have users, they're paying and they're also not churning with really high engagement. I mean, that's a fantastic opportunity for us at Seed to get involved with. And frankly, the big change we see is like prices have gone slightly down, and there's more opportunity for us Seed guys to get in at good prices and into real businesses with fantastic entrepreneurs. So that's kind of the simple way we see it.
And James, I know Bullpen had this sort of post-seed model several years ago before when the good times were still rolling. So what's sort of the difference in the type of deal flow you're seeing and the type of companies that are knocking on the door?
Yeah, sure. That tees me up for my favorite stat of the history of the fund. So in Fund 1, the average pre-money valuation we paid was about $9 million. In Fund 2, it's about $11 million.
And Fund 1 was when, and Fund 2 was when?
Fund 1 was roughly 2010, 2011 on the cusp, and then Fund 2 was really kicked off in early 14, very late 13.
So about a 20% decline in valuation?
20% increase in valuation, but the traction we're seeing between companies has risen from $500K a year to $2 million a year in ARR. So we're paying up about 30% in valuation, but the quality of the company and the traction that you get to see as it gets harder and harder to raise the next round has just been through the roof.
And what about volume of sort of number of companies you're seeing?
Yeah, so there's over 325 dedicated seed funds now, right? So the big mismatch between the companies that have raised seed funding and Series A money available. So just the number of companies that are kind of trying to cross this gap is just larger than we've seen, and increasing at a pretty big rate.
Trudy, what's your favorite trend?
I think I echo what these guys are saying, but most of the companies are also taking a little bit longer to raise the post-seed round. There has to be really good metrics before they get a serious Series A offer. So there is I'll do a debt round, or I'll do a post-seed round, or I'll maybe work on my revenue numbers.
And Jim, you're down in Southern California, right?
Yes.
Welcome. Anything different given that that's where you are, or the same trends playing out there?
Well, so we invest pan-California. I spend about half my time up here and half my time down in Southern California. And our latest fund right now is 50-50. 50% Southern California, 50% Bay Area. So I think that does give us a good lens for sort of what's the distinctions, and I think SUSE is kind of in a similar boat. Distinctions between Bay Area and outside Bay Area, and I would say that there is, Paul's laughing, we just had this conversation yesterday. There is no one likes to hear that their kids are ugly, right? So like no one likes to hear that you deserve a discount just because you're in a certain geography. But it's really two sides of the same coin. I think everybody can agree there might be a valid justification for a Bay Area premium because there's more talent here, there's more follow-on capital here, there's more strategic partners here, there's more potential acquirers here, and in aggregate, there's more venture-backed value creation here. And the unfortunate part is you can't have a Bay Area premium without also having an everywhere else discount. So I think that is somewhat justified, and across our history, we're probably willing to pay a little more for a company here than that exact same company if it were to exist that is not in this market.
But that was the case even before.
Sure, that's not new today. Yeah. To the earlier question, what am I seeing going on these days in sort of the post-seed landscape? And we also haven't branded ourselves as well as as Bullpen did in this life cycle stage of a company. But we've been doing this for our last 2 funds as well for 5 years. So very recently, I think there has been a shift in the supply-demand dynamic that's pretty dramatic. And what I think that is how it's shaking out is the bar's gone up. So middle of last year, if we just do B2B software-based recurring revenue businesses. Last year, middle of the year, if you were a company that was growing, call it 3x year over year and hit $1 million run rate, you got a 23. Like, it was pretty formulaic. And you had plenty of people lining up to give you that $5 million Series A to 23. And that is, I think, and there's been a realization now that those companies that meet those profile are more abundant than everyone thought they might be. And so now investors are realizing, oh, I should be picking and choosing the best ones. And sometimes that means they're at $1.5 million run rate or $2 million run rate or 250 MRR. And so that bar is going up for that sort of safe financing. So those stats can be misleading.
And you notice how little of a difference there is between the old milestone and the new one. So when companies now fall short, it only takes 9 to 12 months. It only takes $2 more million to go from that $1 million a year to the $250 a month to $350 a month to get above the bar now. And now they want to shove $20 million into the company instead of 5 on 20 or raising 20 on 50 because you've already de-risked the deal. And as the A guys move later and later, that's been the dynamic. This whole middle round is propped up.
Shruti, what's an example of a type of company that that would have gotten funded half a year ago that now either can't or has to sort of shift its thinking, shift its model?
Bitcoin. It's definitely an area that's not hot anymore. Even a lot of consumer apps and companies need a lot more traction before now that they get any even seed round. Also, what's changed is I, at the pre-seed seed stage, don't have an appetite for just PowerPoints anymore either. And when I see those kinds of deals, I wonder why someone did them.
For just what?
When I say PowerPoint deals, it's just I have a PowerPoint and an idea, and I'll deliver the product to you in a year or 2 years, and we'll be stalled until then. I think there are a lot more companies now that come to you with, at least a good product, a decent product, and some potential customers that want to try that product, even at their first check, friends and family seed round. So that's pretty different too.
And Chad, maybe the type of company that still can command a premium. Is there anything out there where where they haven't had to take a haircut or a discount?
Yeah, I mean, I think on the last panel, someone said great companies raise regardless of the market, and that's very true. So we've had multiple companies in this theoretically down market raise great term sheets, and they just happen to be fantastic businesses with positive unit economics and growing revenue and net negative churn. And so, I mean, I think to these guys' points, like, like the SaaS businesses we used to fund that hit $1 million ARR, yeah, they'd raise an A. They're still raising rounds, like the rounds just might be slightly smaller. Sometimes you can still justify the valuation, but these valuations weren't necessarily good, right? We've seen higher valuations actually hurt companies far more than it's benefited them on, like, let's say the recruiting or branding sort of PR side and what everyone thinks it's useful for. So I think, net it's a positive for us, and we think for a lot of our founders.
And what kind of, how much attention are you each paying, and maybe I'll ask the question of each of you differently, but to sort of soft landings, landing planes, damage control, however you want to phrase it, finding acqui-hire opportunities for your portfolio companies?
We've seen soft landings go down quite a bit from when we started the fund. So when we started the fund in 2013, soft landings were actually pretty common. And I even saw some early venture funds, some micro VC fund pitch decks, and in those decks, one of their strategies was, if these things don't work out, we're going to invest in the type of businesses that can find soft landings. And we built decent relationships with a lot of the corp dev folks at the big tech firms, and the appetite for acqui-hires and soft landings is not nearly what it was. And even if it is happening today, they're often not even buying the company, or they're literally just straight giving an offer to the employees. So investors still net nothing even in those circumstances. So it's much more, I think it's a harder plan to have as a VC today.
we definitely stay away from distressed deals. We're not a bridge to the A. We're not going to fund your newest product pivot. These are companies that take a lean round and then are able to, kind of skip right past the traditional A to the big round. But from that soft landing equation, it's often a misconception in this post-seed world because you've got a lot of companies that are kind of in that boat where they just miss the mark. It's not a company taking an opportunistic or advantageous round, but they just miss the mark on that round.
But what about companies in your portfolio that, now need some sort of other outcome?
Yeah, I mean that happens. That happens across any portfolio. But when you wait a little later and you get involved at the post-seed stage, I think our graduation rate to the next round is like 66%. So it looks more like the old school days 5 or 6 years ago, where the companies that are able to bridge the gap is much more than I think it's below 10% across the entire industry right now.
And Shruti, what about how are you advising your companies differently now?
The cap is less and less meaningful now, I've seen. It's not just for my companies, but there are a lot of companies that last year could raise first check round at 10, 12, 15 million caps. I think they're meaningless now. If you want a next round of investor to give you a proper check, I think they're going to set their own terms. And entrepreneurs, we advise the entrepreneurs, and they actually themselves kind of realize that it's better to get that over just kind of stick with the numbers that they thought they were going to get at that time. Because to them, cap meant a valuation.
Hey, Jim, are you advising it or seeing companies acting differently with the cash that they've got, slowing hiring, maybe slowing product development, focusing on the things that they've got and how they can get through whatever environment we're in?
It really depends on the entrepreneur and the situation. We are again, we just invest in B2B internet software recurring revenue businesses, net negative churn, high visibility on incoming cash flows from customers. We more often have the problem that founders, we don't think are spending enough. We have a great company where we did a Series C, which was actually post-seed because they did a 500K convertible note at the beginning of last year. They did 5x year over year. Their burn last month was $3,000. And we don't want it to sound self-serving. Go spend more because they're but everything we're hearing is that money's hard to come by. Why are you telling us to spend more? It's like, well, you have $900K in the bank and your burn was $3,000.
You at least have to pay your employees.
So that's the good news. And again, in SaaS in particular, I think we're seeing dramatically increased willingness from business buyers to pay annual upfront, and that's really good for cash flow. So I think one of the things when people are talking about sort of LTV to CAC and payback ratios, they're not actually looking at the timing of cash flows, where you can actually burn a lot less if you are getting upfront pay or quarterly pay from a sizable portion of your customer base. Now, more broadly, I think there has been a reasonably quick adjustment in founder mindset around appreciation for the value of the dollar. I think the Q1 stats that were referenced in the last panel are a little misleading because generally the Q1 deals that got done were inked in Q4, and so it's a little bit of a lagging indicator. If you look at Mattermark data for April, it was down over 30%, 29% on a deal count basis, and I think 37% on a cash basis year over year. So things are really slowing down, and I think it is important to be extra mindful of cash and not to assume that it's infinitely available on attractive terms.
Are you seeing any actual deterioration in the business environment, or does this feel just like a capital markets issue where it's sort of a vicious cycle of investors, concerned and therefore getting more conservative, and that that sort of filters down into the companies, and that can go on sort of for a while. But you mentioned the sort of recurring contract deals are still out there. Have you noticed any companies that are actually struggling to meet their numbers because of a downturn in the economy?
We think it's more the latter.
I would say for the last year we've been mindful not to invest in businesses where 100% of their customers are venture-backed startups. Because I'm in my 16th year doing this, so I got to live through that fun in 2000, 2001. And you know, it sucks when all of your customers cease to exist.
So you're avoiding Soma.
I'm not avoiding Soma. I'm just avoiding the guys that are selling to everyone exclusively in Soma. And we do have some companies that were oriented in that fashion, and we guided them to diversify their customer base.
To add to that, the other thing that I advise my companies to do is charge more to current customers. It's counterintuitive, but if your current customers like what they see and they're expanding with their business with you, then there's an opportunity to charge more than $9 to $100 even, or change your pricing plan a little bit. Because getting to that 1 million ARR with just small $5 a month kind of per seat kind of models are not that exciting actually anymore. That's another change I think that the market has learned. SaaS businesses are good, but you have to do pricing really well.